I'm Howie Lim. This is Money Hacks by the Business Times. Singapore's Economic Strategy Review midterm update signals a harder path to achieving its 2 to 3% annual GDP growth target over the next decade. The ESR highlights future priorities, including global leadership in key sectors, AI-driven productivity, emerging technologies, and firm internationalization. Investors must determine which of these policy directions will genuinely impact corporate earnings, sector performance, and capital flows versus those that are broader strategic goals. Lovely. And how on earth do we do that? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and we've got expert help from Daryl Liew, Chief Investment Officer and Head of Investment Solutions at PhillipCapital, and Cheng Chye Hsern, Chief Investment Officer from Providend.
Hi, Howie. Good to see you. That's a great question. I think for as retail investors, key in terms of actual investment portfolios would be the themes that focus on transforming Singapore's manufacturing, trying to get it to reach global leadership for advanced manufacturing. Some of the other key themes would be to enable AI in Singapore in terms of developing maybe AI products and also just AI adoption across all industries in Singapore. And I think lastly, continuing to be international, continuing to help companies here grow and internationalize and then expand their market reach. So I think these are some of the key things retail investors should keep an eye on.
Yeah, I think if you distill it, there were 7 main takeaways from the review. Broadly speaking, I think you can kind of characterize them into 3 buckets. One was more on trying to develop Singapore from a productivity angle. How, for example, you can actually integrate AI into improving productivity. The second main area was focusing on new growth areas. Growth is a key driver of economic activity. So there's been talk about how do we develop these new areas? How can Singapore leverage on that? And maybe the third one is, if you look at Singapore's history as well, in terms of how Singapore developed as a country, mainly as an entrepreneur trade center, how we can actually use Singapore as kind of like a base, leveraging the region, getting regional companies potentially to use Singapore as a base, trusting Singapore's political system and stability to attract companies to have maybe the regional headquarters in Singapore. So those are the 3 main buckets, like the takeaways from the strategic review.
Yeah, but how should retail investors internalize this? Which is most relevant? Here's Cheng Chye Hsern from Providend again.
As retail investors, some of the key things that investors can think of when it comes to focusing on policy-driven themes would be to, first of all, understand the landscape, because especially for Singapore, our companies are not mainly focused on the domestic market because our domestic market is naturally a bit smaller. But I think the key is to see what some of these policy initiatives can do for local companies to plug into the global supply chain, to add value there, or to grow. For example, it's possible that there will be companies that do semiconductor testing for some of the major semiconductor manufacturers in the world. And so if some of these initiatives can help these companies take the next step to technologically become a global leader in semiconductor testing for key semiconductors that support the AI industry, that might be an area that local investors can take advantage of if there's a listed company that does semiconductor testing. Or if there's a big initiative towards AI and there's more data center build-outs and many of the construction companies or even the data center builders require certain types of raw material. If there's a local company that's listed that has focused on providing specific raw materials that are beneficial for data center build-out, that's also some way that retail investors here can take specific advantage of some of these policy initiatives.
Daryl Liew from PhillipCapital feels it will be challenging for retail investors to distill all that, especially for high-growth area sectors.
Because a lot of that is actually not investable for retail investors, at least from a listed perspective. A lot of the newfangled growth areas, the opportunities actually arise more in the private equity or in the venture cap space. There are areas of opportunity, but maybe that's limited more to the high net worth or to the institutional investors at this stage. But there could be potentially areas for retail investors to participate somewhere down the road. So, for example, if you look at some of the developments that is happening in Singapore, MAS has had a consultation paper recently where they are looking at maybe making these kind of private equity or private asset investments available for retail investors. That consultation paper, we're still waiting for the results of that. But that potentially could then mean that retail investors could then participate in such types of investments moving forward. But at this stage, it's quite limited, especially for the high growth areas. In the listed space, possibly it's really more on the infrastructure areas. Singapore is well known for having a well developed real estate investment trust sector. And I think when we look at some of the new listings that is coming about, there are quite a number of new REITs that are in the pipeline of being listed. That could be an area for retail investors to participate in. But I don't think you're going to get exciting kind of growth because by nature, REITs, you're talking about distributing most of their profits, right, in the form of dividends. So that's more of a dividend kind of play.
And how do we think about policy-driven growth themes? What sectors may benefit from Singapore's longer-term economic priorities? And how can investors balance long-term structural opportunities with execution risks, valuation considerations, and bottom-up fundamentals? We'll try to get our experts to advise us on all that. More with Daryl Liew from PhillipCapital and Cheng Chye Hsern from Providend in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. We've been discussing trying to incorporate national policy into our investment strategies, especially since Singapore's Economic Strategy Review midterm update signaled a harder path to achieving its 2 to 3% annual GDP growth. Sounds all highfalutin and whatnot.
Yeah, I guess in a nutshell, those are some of the key things to look out for. I mean, in the end, it's all about corporate earnings. If you are focusing purely on the investment aspect of these initiatives, so whichever companies will be able to grow their earnings through either support for these initiatives or to plug in and take advantage of the fact that these initiatives are being rolled out and their business model just supports that and helps them drive growth in their business, growth in their cash flows, that's what investors should be looking for.
Fair enough. Should we interpret Singapore's 2 to 3% long-term growth outlook in terms of return expectations? Here's Daryl Liew from PhillipCapital.
Yeah, that's always a bit difficult question to answer because most investors tend to be more global investors these days. Talking to especially some of the young investors, I noticed that not many of them actually invest in the Singapore market. Most of them are investing in the US market, for example. Perhaps that's due to fractional shares. Perhaps that's due to, for example, the Max 7 is more well-known. But I think we've got to kind of distill GDP growth versus potential returns on the stock market. The US market, which has been one of the best performing markets over the middle to long term, the GDP growth in the US is not that high either. And if you're investing in a high GDP growth market expecting high returns, then you should be investing mostly in emerging markets because those are the markets that are giving you high economic growth. But that does not necessarily translate to high investor returns or stock market returns. So I think that's one aspect that investors have got to consider, that a 2 to 3% kind of GDP growth target for Singapore is not necessarily an indication that stock market returns are only going to be like 2 to 3% plus, like, let's say, inflation rate.
Yeah, but when you distill a GDP growth rate like that, what does it actually entail, Daryl?
It mostly entails demographic growth plus productivity growth. The combination of those two is actually what leads to your long-term GDP growth figure. Of course, on a year-on-year basis, there's some fluctuations because of macro concerns, or maybe one sector is doing a bit better, depending on whether you're export-driven or more domestic-driven. But in a nutshell, I think GDP growth is just giving you a barometer of the health of the domestic economy, not necessarily translating directly to investor returns. So I think when you look at the Singapore market per se, having 2 to 3% GDP growth is kind of par for the course for a developed market. So I don't think we can expect Singapore economy to be growing at like 5-6% on an annual basis. That's just not realistic. Even Chinese growth has moderated significantly over the last few years, right? It's just a factor of where the country is in an overall development phase. So I think innovation is what's going to probably drive potential investment returns. And if we can get the strategy right in terms of being in the right growth sectors moving forward and having some of those opportunities listed in Singapore, retail investors could then participate in some of that growth.
So, which sectors or industries are most likely to be structurally affected by the ESR priorities?
Well, you would want to still think about the appropriate size of the position within your overall portfolio context, and also Singapore's overall investable market, even as a percentage of the global market, is not going to be very large just by nature of our small size. So yes, it's appropriate to have some home bias. There can be various factors that lead Singapore investors to have a slightly larger proportion of their portfolio in Singapore companies. But I think investors shouldn't have too much, and I won't want to throw out a number and say that that's the absolute number, but it's a big world out there. And so maybe you maybe shouldn't want to have more than 20-30%, of home buyers in your portfolio, and you should try to look for opportunities in global markets, just because there are many different companies that do many different industries, and that gives you a lot more diversification. For example, the memory chip makers in South Korea have been doing very well, and so the chip makers in Taiwan, the tech companies in China, real estate companies, elsewhere like Hong Kong, Australia, and of course, the US has a lot of high growth tech companies and also many different types of software companies, etc. And Europe also has various companies that are very strong, like pharmaceuticals, also luxury, etc. And yes, of course, how can I forget to mention gold? I mean, there are no gold miners in Singapore. So, there are many gold mining companies listed in various parts of the world, and even energy, oil companies. So those are opportunities that you can't get just focusing on the local market. So investors should keep an eye on also global opportunities.
I'm starting to feel as though there may not be much of a difference. We're still hearing the same advice. Diversify, diversify, diversify. Are there even risks or uncertainties investors should be mindful of when investing around policy-driven growth themes?
Well, I think for one, the assumption is that the policy decisions are correct, subject to debate whether or not this direction is the right one to go towards. Because I think Singapore has proven over the past 60 years that we've, by and large, got most of the policy measures right, but not all of them have been correct. Not all of them have worked out exactly the way that they were intended to. The second aspect is obviously one of implementation, because it could be the right direction, but implementation then maybe falls short. Maybe it peters out or is not as effective as it was intended to be. This goes back to the whole debate about big government and small government. If you look at different countries and the way their development models, the US has been one, generally speaking, of small government, where innovation is being led by the private sector. The capital markets basically are the ones that decide where the money is allocated to. Basically goes to the areas where the most innovation is and where the returns can be generated. Whereas if you look at Europe, which tends to be a bit more controlled, more regulated, where there's arguably less innovation happening because of that control factor, the more regulated sector.
Okay, so if you're using that as an analogy, Singapore looks like it'd be more similar to the European regulatory model, right?
It really boils down to what you believe in, whether you believe that governments can make the best capital allocation decisions. Singapore has a bit of a better advantage compared to some of the other Western governments, because the problem with that is that if the government changes, then you have a flip-flop in policies. Maybe the left side party who's in charge this year decides on these policies, then they lose, and the right come into power, and then they change policy. So Singapore, at least we have stability in terms of the same party that's been ruling. There's been a bit more having a similar kind of strategy, and they're able to see it through over multiple cycles. Ultimately, it boils down to your view on whether you think big government is the right way to go.
Takeaway order Money Hacks 259 is up. Translating Singapore's economic strategy review into investment returns is tough. Focus on corporate earnings in sectors like advanced manufacturing and AI adoption, which are supported by policy. Don't let policy bias your portfolio. Diversification is still king. A big thank you to Daryl Liew, Chief Investment Officer and Head of Investment Solutions at PhillipCapital.
No worries. Most welcome.
And Cheng Chye Hsern, Chief Investment Officer from Providend.
Thank you, Howie.
This has been Money Hacks by the Business Times. I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.